Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is John Rubino from DollarCollapse.com and co-author with James Turk of the book The Money Bubble. John, thank you so much for joining us today.
Hi Elijah, good to be back.
All right, now the first topic I'd like to discuss today is how it seems like 2017 may have been the peak for the economy. And so basically, it seems maybe all downhill from here. What is your perspective on that?
Well, it's been a nice run. You know, the economy started to expand again in 2009, which means that we're 9 years into a recovery. That's really long by historical standards. Usually 6 years or so is about normal. So this one is among the longest economic recoveries that have ever taken place. And the bull market in equities is also right up there. You know, it's in the, one or two, first or second longest that we've seen since really the Great Depression. So just based on those kinds of general statistics, you would think that we're towards the end now. And we are starting to see a lot of signs that that things are kind of running out of steam from an asset price standpoint, for instance. You know, the stocks have gone up to the point where by any valuation measure you want to use, they're at the high end of their historical range, which means they're at levels that in the past, every single time in the past, were followed by a big stock market crash and a period of underperformance. Bonds have had a literally 30-year bull market where they've gone up in price, which is to say interest rates have gone down year after year after year since the 1980s. So we're probably at the end, and some shorter term signals are also giving us the same message. For instance, the yield curve is starting to compress. Now, what that means is that the difference between long-term and short-term rates is shrinking. And that's usually because we're at the end of a cycle, money is getting tight, either because the Fed is raising interest rates or because lots of people are trying to borrow short-term. And the longer end of the bond market is wondering if we're going to have a recession at some point and inflation is going to slow down. And so it's less interesting to buy long-term debt. And so the yield on long-term bonds isn't rising as fast as the yield on short-term bonds. Now, that usually precedes a slowdown or a recession as well. So you put all that together, and yeah, there's a pretty good chance that 2017, 2018 will be seen as the high watermark for this recovery, and that we'll have slower growth and or a recession out there in the not-too-distant future. And now add to that the fact that there's an insane amount of debt in the world right now. We have been borrowing more and more money year after year after year, so that we are way more highly leveraged than we were at the beginning of the debt-driven crisis in 2008, 2009. So let a slowdown start or let a bear market in equities or bonds really get going, and we could see a crisis that's much worse than the last one just because we've got so much more debt to deal with. Pretty much everybody in the world is more highly leveraged than they were back then. The U.S. doubled its national debt at the government level and then took on a lot of unfunded liabilities and encouraged the private sector to take on record amounts of debt. Student loan debt is at record levels, credit card debt, car loans, corporate debt. It's all at record levels, which means a lot of bad loans have been taken out, just, on principle. When you hit a record level in some kind of sector debt, usually the last batch of loans that were taken out were pretty dicey, so you end up with malinvestment or whatever you want to call it, junk debt rising in proportion to the overall debt. And that makes that sector a lot more vulnerable because that junk debt is the thing that blows up first on you when things get tough. Now, if the whole world has done that, China, Europe, Japan, the US, private sector people at every level of every major society, we have the potential for something bad happening somewhere in one of these sectors, in one of these countries that metastasizes. So we're at extreme risk of a big crisis going forward, just, not for any kind of mystical, magical, or ideological reason, just because we borrowed way too much money. Historically, that's been problematic. It's led to crises. And this time around, there's no reason to think that it won't, except that central banks are poised to jump back in with easy money, at the drop of the hat. A 20% drop in share prices, we'll see massive new QE programs from all the world's central banks. And that's kind of a wild card. That might be seen as a sign of weakness on the part of central banks, that they're jumping in with these extreme policies when, the market is just dropping as it tends to do, or an economy is slowing down as they tend to do after 8 or 9 years of expansion. And that might exacerbate the problem because people assume that things are much worse than they realize if central banks are being this extreme this soon. Or it might, push asset prices back up again. We can't know because this is kind of uncharted territory. But that's really the only wild card. By every historical measure where we got some precedent, it doesn't look good for the next few years.
Now, as for 2018, if we're not going to see growth, what are we going to see? You said in your article it'll be quote unquote messy.
Yeah, well, right now we are growing, and there's no way to know where that ends and how it ends. But as I said, the yield curve and stock valuations and lots of other things are pointing towards a disruption in this steady growth rate that we've had. That it could be 2018, or it could be further out, but it's a fairly safe bet that the news flow gets less and less optimistic and more pessimistic and choppy going forward until the psychology of the marketplace just completely changes. We shift from focusing on the good news and ignoring the bad news to vice versa, to focusing just on the bad news. And there's a sign of that happening right now in the tech stock market in the U.S. Tech stocks are getting whacked today as we speak because the bad news that's associated with a lot of big companies is starting to become the headline news for them. For instance, Facebook, which has had issues with how they run their news feeds and what the trolls are doing on there and whether there's fake news, et cetera, et cetera. That's becoming the dominant story with Facebook, rather than how fast they're signing up new members and how much their advertising revenue is going up. Tesla, for instance, has had mostly good news and mostly support from the analyst community. But now the fact that they're having trouble ramping up the production of their new electric car has led, for instance, Goldman Sachs to put out a sell recommendation on them today. That's really unusual for a big investment bank to tell people to sell the stock of a company that is potentially one of their customers. Tesla's going to issue more junk bonds in the near future. Goldman Sachs would love a piece of that deal. And yet they're still out there telling people to sell the stock. That's the kind of thing that implies that the psychology of the marketplace is changing. And you're seeing it in tech stock prices across the board lately. They're really getting smacked today. And a big part of that is that now we're looking at companies like Amazon and Netflix and saying, all right, good business models, they're growing like crazy, but they're not generating any cash flow, and how long can they go on borrowing more and more money and not generating cash flow? 6 months ago, everybody, especially the hedge funds that were loading up on those stocks, were looking at that same story and saying they're going to grow forever. They'll figure out a way to make money at some point. Now they're asking the question, how are they going to make the money? And that's a sign of, a psychological change that tends to precede and then be coincident with bear markets. When people start looking for the bad news and trying to figure out who's next, who's going to report bad news next, they're usually selling those stocks or selling them short. And, it could be that we're heading into something like that. High volatility, more of a focus on bad news, a general downward bias in the markets. That's how or bear markets start. They end with everybody just throwing up their hands and selling everything in sight. And we're nowhere near there yet. But once this thing really gets going, that could happen sooner rather than later. So we can't know if this is it, but when it starts, when the next bear market starts, it'll kind of look like this.
Right. And at that time, do you think it'll be an opportunity then to go back into stocks once they're very low?
Someday, there will come a time when these things are so cheap. Like in 2009, for instance, the world was incredibly pessimistic. Everybody was terrified, and everything was going to end. The world as we knew it was going to end, and so people weren't buying stocks; they were going to cash. That would have been a great time to buy stocks. And we'll see a time like that in the future. Actually, the next book that I'm supposed to be working on is on that premise. It's called After the Crash, and it's going to be about the technologies we should be studying right now, because they'll get incredibly cheap in the next bear market, and we should be ready, with an understanding of them, so we can buy these new next generation tech companies at the very bottom. Where that bottom is going to be is anybody's guess right now, because as much as people have been ignoring historic valuation measures on the upside, they will ignore them on the downside. So we'll probably overshoot what in the past looked like reasonable entry points for a lot of these stocks. So it's going to be very hard to say beforehand, where you should be buying Facebook after it's down 50%, or should it be 70%? And I don't know. I don't have an answer for that. But I know that somewhere down there is the bottom, and it'll come when the psychology changes and people start nibbling at these things and they start going up a little bit, and then people get excited again. The game will begin again. But right now, the part of the game that we're probably heading into is the rougher part, where it gets harder and harder to justify buying pretty much anything. And, again, I don't know if that's this year or next year or 5 years from now, but the bias is probably going to be in that direction going forward.
As for currently, what is your perspective on where investors should be putting their money?
Well, in times of crisis and bad psychology, et cetera, precious metals usually do pretty well. Gold and silver, they're holding up lately. I think, let's see, gold is even up a little bit today with the stock market getting crushed. And that's just the way it works. When people are scared, they go back to things that tend to be either counter-cyclical, in other words, trade in the opposite direction of equities, or where there's a long history of stability in terms of purchasing power. And that's what gold and silver are. You can go back to the days of the Roman Empire, and an ounce of gold bought you a pretty good man's toga. Today, it buys a decent man's suit. So gold has held its value for thousands of years through revolutions and wars and new ideologies and natural disasters. Name the horrible thing that's happened. Gold pretty much bought you the same amount of stuff before and after. So there's a decent chance, a reasonable assumption, that the same thing will happen this time around with precious metals. And so that's where people go when they want to hide out. And should there be an equities bear market, or some kind of big disruption in the bond market, or some kind of political thing, there's a lot of things that could happen. Geopolitical, if we get into a shooting war with Russia, the impulse for a lot of people is going to be to find safety somehow. And that could be short-term treasuries, which, if you lend money to the U.S. government for a year, that's a pretty good chance, since they have a printing press, they will pay you back. You won't lose. Gold and silver are kind of similar to that idea, that they're going to buy you pretty much the same amount of stuff 5 years from now as they buy now. And if we have a currency crisis in which the focus shifts from stocks and bonds to the dollar and the euro and the yen, which I think is coming out there, at some point we lose faith in these fiat currencies that are being mismanaged so badly. then precious metals will go up in fiat currency terms dramatically. Like we saw, from 2009 to 2012, give or take, gold and silver rocketed. They were the best performing assets out there. We could be seeing something like that again at some point, at which point you want to have already bought your gold and silver because it's going to be hard to get it. And you want to have taken some positions in mining stocks that basically have gold and silver in the ground and that trade really with great leverage, because that gold and silver in the ground tend to become a lot more valuable when the price of the metals go up. And we're seeing some action in the precious metals mining market today that I think is really interesting. Hecla, a big silver miner, bought out Klondex, a junior gold miner, at a 50-some% premium to the previous close, which is a nice pop for somebody that just bought Klondex stock, and several other junior miners are way up today, probably in sympathy. In other words, people are looking around going, well, what's next? Which is going to be the next takeout for a 50% premium? Is it Wesdome, or is it Novo Resources? Which one's it going to be? And I think that's an interesting dynamic, because it's really fun to be in junior miners when something like that takes hold, because these things are ridiculously cheap, very thinly traded, and they can rocket when some outside money starts to flow in. In other words, where momentum players or hedge funds who currently aren't bothering with precious metals in any way start looking around for the most aggressive play to get into precious metals, that's the junior miners. And so a lot of these things, it's almost a shame when they get bought out, because a 50% premium is a nice trade. But some of these things will go up by 1,000% if they're allowed to go from a junior to a mid-tier to a major over the period of a decade or so, which has happened in the past and which has resulted in spectacular profits for people. So I'm kind of torn by this takeover activity. It's totally predictable, because the major miners aren't replacing their reserves. They can't find enough new gold and silver in the ground to match what they're taking out each year. So they're kind of evaporating, and they don't want to evaporate. So one way to get around that is to buy some junior miner who's found a promising property that's big enough to make a difference to a major. And so they're looking around right now for companies like that, for the next Klondex, where you can add appreciably to your production over the next few years by buying this junior miner right now. And so that could be the dynamic in the junior mining sector, where another one gets taken out, people plunge into the one that looks like the one after the one that just got taken out, and it just goes on and on like that for a few years.
Now, moving our focus back to the economy, you recently wrote an article about how default rates are really low compared to corporate debt levels right now. What does this signal?
Well, corporate debt has been soaring, but default rates, in other words, the percentage of companies that can't pay the interest on their loans or default in some other way, isn't rising along with the amount of corporate debt. And that's unusual. Usually they move together, because when a lot of new debt is taken on, that usually produces a lot of new defaults. This time around, that's not the case. And the reason for that is that money is so easy, or it has been so easy, that even a weak junk bond borrower can refinance its debt. Somebody else will lend them money so they can pay off their old bonds and they don't default, But as soon as money gets tight, the dynamic in the junk bond market is that the weakest borrowers are cut off. They can't get bank financing. Nobody will take their bonds anymore. And so they have to make do with their own cash flow, which is inadequate. And so they do default. They go bust. And that spooks the market and makes people wonder who else is going to default. And they start selling the weakest tier of the junk bond market, which causes that to crash. And then they start selling the mid-range of the junk bond market, and that crashes. And so you get this kind of cascade failure of the junk market, which coincides usually with a downturn in equities, because junk and equities trade in a very similar way. You can think of junk bonds as basically just the equity of weak corporations. So when a sector of the junk bond market blows up, that's a pretty serious signal. Now, that's not happening yet. Right now, things are great in the junk bond market, but they're so great that based on history, bad times are probably coming. As the old saying goes, stability breeds instability. And we're seeing the stability part of the junk bond market now, where, if you're a junk issuer, you can borrow for just a little bit over what the government has to pay to borrow. And that's it's crime against nature, of financial nature. You shouldn't be able to borrow that cheaply. It's just wrong. That means there's something out of balance in the money markets when that happens. And that is usually redressed by the last batch of borrowers going bankrupt because they borrowed too cheaply. And when it comes time to borrow again, nobody wants to lend them money because it's become clear to the market that 4 or 5% on a junk bond just isn't enough. You need 6, 7, 8, 9, 10% to lend money to these guys. But if they pay 8 or 9% for money, they go bankrupt. And that's the dilemma that they'll find themselves in when history reasserts itself. Again, we don't know when that's going to be, but it could be soon. If the stock market continues to fall from here, that'll affect the junk market, and then money will just dry up for weak companies across the board. Nobody will want equities, nobody will want junk bonds, and then boom, the system, it seizes at that level, and then we get a recession, which is overdue. As we said, a recession and a bear market are wildly overdue based on history. So it wouldn't be a surprise for it to happen sooner rather than later.
All right. Well, John Rubino, thank you so much for joining us today. Did you want to share with the viewers any last thoughts you had and where they can find you online if they're interested in learning more?
Oh, yeah. I run dollarcollapse.com, which is a site that covers all this stuff. It's updated daily. Come in the morning, and you'll be pretty much up to date on the gloom and doomy side of the world. And other than that, I think it is time for your viewers to start paying attention to protecting themselves and to look at precious metals and to look at maybe even short selling, depending on how sophisticated you are. Betting against an overvalued stock market has historically been a really good thing to do. Some fortunes were made in the last cycle when people decided the housing bubble was about to burst and they bet against the housing bubble and the related stocks. Someday, in the not too distant future, we'll see an opportunity like that again. And I think your more adventurous viewers might want to consider, dipping their toes into the short selling market.
All right. Once again, John Rubino, thank you so much for your time today.
Thanks, Elijah.